Welcome to the Cash Flow Compass Show, where we bring real estate investors and deep dive into the best strategies that are working today. I'm pretty excited. We have Joel Gigax today, and he's going to be talking to us about a topic that I'm personally not very familiar with, but I'm pretty excited to talk about it because we were talking about it a little bit previously, and it got me interested. A little bit about Joel. He's a full-time real estate investor, the co-founder of Influence Capital Group. After attending St. Louis University in 2015 as a pre-law major, Joel learned about real estate investing and decided to pursue a career as an investor rather than an attorney. In 2017, he began his career in real estate investing as a wholesaler. He worked for the third largest residential investment firm in St. Louis and worked his way up to a partner status. He then went out on his own and co-founded Influence Capital Group with his partner James Gleason. Joel has personally been involved in over 500 residential real estate investments and has worked as the acquisition director for two national real estate funds. Currently, he and his partner have over $6 million in assets under management, totaling over 100 units, and have raised over $1 million in investor capital. Joel, welcome to the show.
Glad to be here. Thanks for having me on.
Absolutely, man. I'm excited to get started. Why don't you? I'm pretty excited. Like I said before, we have some similar backgrounds on how we got started, and but it sounds like even within the same field, which is multifamily, we do some things that are a little bit unique to each other, right? That are different from each other. So I'm pretty excited to break it down and dissect that, what we were talking before, which is the Section 8 stuff and everything else that you're doing in the space. But why don't you get us started and tell us a little bit about how did you get started in this?
Yeah. So as you alluded to, I went to college pre-law, just like someone goes pre-med if they want to, go to medical school. Had senioritis pretty bad by the time I graduated, and I was looking at real estate investing, fell in love with it, long story short, and ended up, earning my stripes at a firm here in St. Louis, downtown St. Louis. And from there, I spun off on my own, co-founded Influence Capital Group. And what we do now is we buy single families, two families, and four families for buy and hold purposes. And we typically do a value add and what everybody knows now as the BRRRR strategy, to where we're buying it, renovating it, renting it, refinancing it, and then getting our investors' capital back and putting that back into the next deal or two.
I love it, man. So you do single family residentials, duplex, quadplex, and you also.
We have a 17 unit. That's the biggest one that we have currently between my partner and I. But everything else in the portfolio is single family, two family, and four family.
I love it, man. And the value add strategy, the BRRRR method. Are you finding, I'm kind of curious, are you finding that some of the numbers are getting harder to pencil in as the interest rates are rising?
They are, and you're sensing that in the market as well. Sellers know it's a seller's market right now, and it can be frustrating at times because they have an inflated sense of value often in their assets. But we are getting creative, and also we do more direct to seller marketing, I think, than most other, your standard active operators who are doing buy and hold. Most people just build broker relationships or agent relationships. And, if they find a deal on the MLS or something off market that a broker or agent brings to them, then that is how they're getting their deal flow. We do have a pretty robust direct to seller marketing campaigns set up. So we'll do, as of right now, cold calling and texting and ringless voicemails, which is basically when you send that out, it doesn't ring their phone. It just goes right to their voicemail box. And then they check the voicemail and hopefully call us back. So that is how we're getting creative with keeping deal flow consistent, and also finding people who are in motivated situations, maybe pre-foreclosure or pre-probate, or We just know that they have a lot of equity in their house and they've owned it for 15 plus years, 20 plus years. So they might be looking to downsize and don't have to get retail value or top dollar because they have so much equity. And so that's how we've been keeping deal flow consistent, because prior to that, we were doing the traditional, cold calling agents, introducing ourselves and hoping that they would call us whenever they did get a good deal. So.
I love it, man. Yeah. Yeah. And for sure, nothing beats going straight to the source, right? Which is obviously direct to seller.
Right.
I do believe we do the same thing in our wholesaling company, which is exactly what you mentioned, right? Where you go straight to the seller. And I think a lot of good deals come from that. So I love that, man. We sort of alluded a little bit into the asset class, but can you tell us a little bit about why the asset classes that you guys invest in, and why is it that you invest in those?
Yeah, we started, both James and I can't remember off the top of my head what his first deal was, but for myself, it was a single family, and then it was another single family, and then a duplex, right? It kind of just makes sense after that. Once you understand the single families, duplexes, and that much more difficult, and and so on and so forth. So we started off with that. The inventory, I feel, is there's more supply, and so when we work hard to put ourselves out there, talk to investors, get investors comfortable, show them that we're good operators, and provide good, consistent returns. And then they invest in the business. And when investors invest, they want their capital to be at work, right? They don't want it to be sitting and not, gaining them a return. So we found that we can keep investors' capital at play when we are investing in an asset class that is more readily available as far as inventory goes. And then also the direct to seller marketing that we were talking about, it works. Now, I'm sure someone's going to hear this and prove me wrong, but we found that it works better when you're dealing with people who own a single family or a duplex, or it's their primary residence. It doesn't work as well on, commercial owners, who might be owning something in an LLC, or who might be sophisticated and have, 1,000 units, and, a gimmicky text isn't going to work as well on them. So, yeah, mostly just keeping our investors' capital at play. And it's also something that is a little bit more liquid. So if a recessionary event did occur and we needed to liquidate, it's easier if it's 100 single families and we need to sell off maybe 20% of them, versus if it's just one building that's 100 unit. If you need to liquidate or get some equity back, it's really no way to do that with just one asset. So we do like the larger multifamilies. As I said, we do have a larger one, and we are looking at investing in those, but this is just a different piece of the portfolio.
So I love that, man. A couple points you bring up, right? So easy to sell a couple of units as opposed to having to sell. For example, if you own 100 single family homes, comparing it to someone that owns 100 unit apartment building, you're saying it's a lot easier to sell a portion of that portfolio that you currently have without having to get rid of the entire thing, which will be the case of owning a 100 unit apartment building, right? If you have to sell it, there's no way of cutting that one in half.
Exactly. Yeah, there's no way to sell a couple of units, right? And yeah, that's exactly it. And there's a downside too, right? So when you're renovating 100 single family homes, which we haven't renovated 100 single family homes at one given time, and they're scattered across different parts of the city, it makes property management and construction management much more intensive. And also you are spending a lot more like human capital doing that, versus if you have one construction site for 100 unit, multifamily or apartment building, and you have one property management group managing one site. There's some efficiencies there that we don't have right out the gate, but we work hard to set up systems to make sure we are running just as efficient as if we were having all the assets under one site, under one roof.
I love that, man. I love that. And you touched on two other points that I think are interesting, which is one is the liquidity. By having the smaller unit, like the single family homes, you are referring to is more of a quicker turnaround. You acquire the property, do what you need to do, and either refinance or sell it, and capital goes back to the investors.
Yeah, exactly. We do it that way because it's just much easier to raise capital when you do it that way. When you're talking to an investor, and they're both, great business models. Obviously, there's guys that are ultra successful that are just buying large apartment buildings. There are national institutional funds that are buying nothing but single families. I've worked for two of them as an acquisitions director, and they're both great business models. But for us, we started off raising capital from friends and family, and I didn't grow up in an environment with a bunch of high net worth individuals, right? I grew up in a blue collar family, had blue collar friends, and when you're asking for $25,000 or $50,000, that could be their a good portion of their life savings. And so when you're asking them to invest and keep that money invested for 3, 5, 7, 10 years, it's a much harder ask versus, hey, invest 50,000 with us, and in 4 months we're going to get that money back to you, and then you're going to start earning returns on that capital. So their risk profile is lower, right? And they get their capital back, and now hopefully they choose to reinvest and continue to reinvest, and that's seemed to work for us really well.
That's awesome. I love it. And yeah, I like that. I like that quick. We've done that before in the past as well, raising capital for single family homes. And I like that because, like you mentioned, it's a quicker turnaround. Some investors like that a lot better, like you said, than being invested in a deal for 5 to 7, 10 years. And even though the numbers sort of turn out to be the same at the end, there's something about them having the flexibility of having the money back, and then knowing like, okay, I got my money back. I can turn around and put it out there in the market again, But yeah, I absolutely agree with that. Joel, why don't you tell us some of your unique value add strategies that you're implementing?
Yeah, I like this question. We have, like you said, have found it more and more difficult to find good deals. We used to be able to buy properties with a minimum of 30% equity capture at the purchase, each and every week, right? So now we have to work. So we talked about doing direct seller marketing to increase deal flow, but at the same time, when you're looking at a property and you got a hedge fund or a real estate fund buyer that is buying for a fund out of California who raises $30 million a quarter, and you're both trying to make an offer, usually we were finding it difficult to win those deals. People are just overpaying for deals right now. And, we believe in sticking to our acquisitions criteria and sticking to the ROI metrics that we laid out from the get-go with our investors and still have to this day. And we don't stretch on that just to get deals, right? Because that's how you start to get in trouble. And so we started looking at ways to where we could produce more income or maybe take risk out of a deal in order to purchase more deals. So one of the things that we looked at was, I'd say in the past, we would just buy a multifamily, put your standard market rate tenant in there, which is somebody who is just, a standard tenant, right? And then long-term 12-month lease, your standard, what you would consider a standard tenant. And that worked for a long time. Then all of a sudden it became difficult to buy deals doing it that way with the same risk profile. And people are asking for more money for an asset that was, 20% cheaper 2 years ago. And so what we decided, we looked at doing short-term rentals, and we've done a few of those where we will, and don't quote me on this, but typically with a short-term rental, which is like an Airbnb or like traveling nurses, you're going to be making 20 to 30% more in income. And when you can do that, you can typically pay more, right? And so that was one strategy. But the downside of that strategy is typically you will have to have a higher construction budget, and that's because you're doing nicer finishes. As the short-term market grows more and more, you're competing with, it's just like hotels. If you're looking at hotels that are priced the same and one's got a great view and amenities and a pool and a breakfast, and the other one's just got 2 queen beds and a small stuffy room that looks like it was renovated in the 80s, then you're choosing the other one. And that's the same thing for the short-term rental market. People are really going above and beyond to make sure that they are getting tenants in their properties every night. And so you're spending more on construction. Also, you are spending more, you have a line item on your budget that you don't have with your standard rental, which is furnishing. So you have to completely furnish the entire unit. And you have to think about everybody who's staying there. And what I mean by that is, you might not think of putting a ironing board and an iron in there, right? And if you have a business person that's looking to, stay for 1 or 2 nights and they need to iron their suit or their dress pants, whatever, and they don't have that there, they're not going to choose your property, no matter how nice of finishes you put on it, and no matter how nice of a couch and, light fixtures you have in there. So there's there's a budget item as far as furnishings that goes into it. And that is, I would consider a con of the short-term strategy. And then, so that's one unique value add strategy that we started doing. And then another one is on the flip end of the spectrum, where we're doing Section 8. And Section 8, the reason we like that is you get guaranteed rent, you get longer term tenants, you can get above market rent, you get annual rent increases, and also that means lower vacancy rates and typically lower construction budgets, and we can go into why that is here later on. But there's a lot of pros to that side, and there's a lot of misconceptions around Section 8 or government subsidized housing that, we live in an age of fake news and false information or misinformation. And there's a lot of misinformation around Section 8. We call that the recession-proof portion of our portfolio, and it's more cash flow centric versus investing in these nicer multifamilies in nicer areas is more of, appreciation and focus. So,
Dude, so you brought a lot, you just threw a lot out there right now for us. So let me just recap it. So you guys are in the short-term rental space and also in the long-term rental space with the Section 8 variants, right?
yeah.
Do you hold any long-term rentals that are just straight up normal?
Yeah, I'd say about 90% of our portfolio is, and that's because over the past, so my partner and I both started in 2018, and we didn't start together. We actually both worked at the same firm that we talked about in my intro, and then from there became friends and kept in touch, and we're doing the same thing, right? And then we co-founded Influence Capital Group, and so the portfolio that we built up until that point was standard market rate tenant, and no real unique value add strategy added to it. And deal flow allowed us to do that, but now the market doesn't, so we have to get creative.
I love it, man. So I love short-term rentals. Got some short-term rentals myself, and I agree that 30% higher cash flow as compared to a long-term rental, right? But I see that downside as well that you just mentioned. There is the potential of something so little like a hair dryer or the iron, right? The ironing board, all these little things that you sometimes don't think of from coming from like a long-term rental perspective, just because you're so used to that they provide themselves whatever they need, right? You're just providing the house and that's it. So I can see that being the con. But I love it. But
the other thing I would add to that is, and just to give the listeners a baseline for the things that I'm saying, is I live and invest in St. Louis, Missouri. So when we're talking about short-term rental, it's regulation that St. Louis, Missouri has. We're talking about Section 8 housing voucher programs. That's how the housing vouchers or the housing authorities work in St. Louis. It's probably different for both, and various markets. But so for St. Louis, we don't have any regulation, or very much at all regarding short-term rentals. So in some states, they have already heavily regulated that space, and it gives investors a sense of security in the sense that they have been there, done that, and they've hashed out all the issues, and they're not going to get hit, they're not going to get blindsided by some regulation that might make their investments not as, profitable. And so with that being said, when we do buy a multifamily that we're looking at doing potentially a short-term rental strategy with, we have to keep that in the back of our minds. And so we still have to make that property work at as a long-term market rate type deal, in case, St. Louis comes out with just some, regulation that just kills investors' ability to do short-term rentals, or maybe prevents it entirely, or you have to get a license or whatever. So if that happens, we have investors ask, well, what happens if that happens? How would the asset perform in that case? And we can't show them an investment analysis that says, well, it wouldn't,
Right.
And so
right.
we have to show them, well, if that happens, then we put a market rate tenant in and it wouldn't perform as well, but this is how it performed. So really that's how the Section 8 came about. That felt a little bit still too risky for us. And so we started looking at, government subsidized rent programs, and Section 8 is probably the most well-known one. It's and it's great for a lot of reasons.
As far as the Section 8 goes, are rents deep? Can you dissect that a little bit for us? Are rents higher or lower than market? Are they pretty much on market? What's the percentage that the government pays versus how much the tenant pays?
Yeah, so the government can pay up to 100% of the rent, and it's based on, so the tenant pays 30 to 40% of their income. So if a tenant makes, and also that income goes towards everything: utilities, the rent, the rent amount, and anything else, any other cost regarding, renting out a unit. So what's great about that is you have guaranteed rent from the government, anywhere from 70 to 100%, right? And on top of that, you can ask, at least in St. Louis, they allow you to apply for a rent increase every single year. And that's great as well. And so right now, and also in regards to rent, and this is in most markets, the waiting list for Section 8 is so long because the supply is so low, and a lot of that's due to misinformation. And so landlords, stay away from that, or investors stay away from that. And so the supply is low and the demand is high. So in St. Louis right now, I don't have the exact number, but the waiting list is 2 to 3 years long. So if somebody is at the poverty line, or maybe right, slightly below it, then they need assistance from the government to actually live in a property, they have to apply, get approved, and then they say, great, you've been approved. We'll let you know when a spot comes up in 2 or 3 years. And so with that being said, the housing program is incentivized to, be very competitive with rental rates, because if they're not, then landlords aren't going to, put Section 8 tenants in their home, because it doesn't make sense, because they're getting less rent. So what we've seen is we are getting above market rent, and also, being able to apply for rental increases is just, the cherry on top. And last thing I'll say, just to tie all that together, is if you think about it, a tenant, every year that they stay, they're incentivized more and more to stay there. And that's because if their income stays the same, and you're buying properties in a good neighborhood, or at least like a B or C class neighborhood that's appreciating, and maybe there's some development going on, as the neighborhood gets nicer and the amenities around the neighborhood get nicer, if their income stays the same, they still only pay 30% of what they make. And even if we're getting rent increases from Section 8 and we're getting more income, the tenant is paying the same amount. And they're more and more incentivized to stay there, because eventually they would not be able to afford to live in that neighborhood. And it's really great. It incentivizes them to stay there and not move.
Dude, I love that. What's typically the rent increase per year, like percentage wise?
I don't have that number, but I do have a number. So right now on the St. Louis Public Housing Authority website, they say that they pay up to 110% of rent. So I just got off a call with another investor yesterday who does nothing but Section 8. And what he does is she looks at 5 or 6 different websites, Zillow, Rental Meter, Apartments.com, Rent.com. The Public Housing Authority actually has a rent estimator based on their data. And they get a really Zillow, and they get a really good idea of what they think market rent is. And then the housing authority sends them their rent voucher saying, this is what we're going to pay you in rent. And they said it's been 120 to 130% of market rent. And again, that's not always the case. I don't know how it is in other markets, but it all comes down to supply and demand. They need to place these people and to shorten the list. And in order to do that, they will sometimes pay even higher than what they state on the website, which is up to 110% of market rent.
Wow, it's interesting. That's awesome. So I kind of want to get the perspective now. A lot of our audience are investors that want to seek opportunities to place their capital, right? So, so let's say I'm an investor and I want to know what kind of splits returns will I get if I invest with you.
Yeah, so we did a lot of research on this. We wanted to see what our competitors were doing, not only here locally but in the region, and wanted to see what they were offering, and then we wanted to offer higher returns. And so on our website, you can actually sign up for our investor newsletter, and in the very first newsletter, it will send what our returns are. I don't like to put those out there because then in a year from now, if they change, then they hear this and they call me and they're different, right? So but they're healthy, and I think that they're healthier than other people who are in the same space. And we make it very clean cut. So we're a fee-free investment firm. So some investment firms will do like an acquisitions fee, a property management fee, a dispositions fee, and a performance fee, and and they base their income on taxing the entity and the assets. We do no fees. We do a straight up equity split. That's very healthy. And in the end, when you boil that down to an IRR, internal rate of return, or an AAR, an average annual return, or a cash on cash return, they're they look great. And of course, we have a ton of case studies that show what our historical returns have been over all of our investments, and they're great. And when you burr out of deals, right? So an investor gets all their capital back, and then they're still getting cash flow based on their equity split. The cash on cash is infinite, right? Because they have all their money back and they're getting money on $0 invested at that point. So, but yeah, that's why we just make it really simple. It also helps with investor reporting, right? So we're not having all these complicated reports that we have to pull our hair out and go through our accounting system to put together. And it's been pretty great, and they've been pretty happy about it.
Dude, I love that. And I love what you just mentioned. I think sometimes a little bit hard to translate for someone that is not very well versed in real estate, understanding the concept of refinancing, giving people their money back, and keeping their equity in the deal is sometimes kind of hard to understand, because this is probably the only investment strategy, like in real estate, where you can probably do that, right? And maybe there's something else out there, but it's something that you don't see in stocks. So for a lot of people to hear that, it's sort of kind of out there, right? So it's possible and it's awesome. There's nothing better than getting your capital back, keeping your equity in the deal. And this is how you can really compound and start building a really nice nest egg, and increasing your generation of wealth, right? Every time you get your capital back, you deploy it out again into more deals, and the more times you keep doing this, it just compounds, and it's like a snowball effect, right? just keeps
Yeah.
getting bigger and larger and larger and larger. I love that, man. Um,
Yeah, we use the same term when we're talking to investors. We say, hey, with this strategy, you can snowball your original investment, truly snowball it. And it's funny because we use the same term.
I love it. What's just kind of curious, are there any downsides to the Section 8 strategy?
Yeah, I'd love to say no, but there are. So there are more inspections. So the government, if they're going to be paying the rent, they are expecting you to keep up with the property. And that's a misconception a lot of people. I'd say that's one of the main misconceptions people have about Section 8 is that, oh, those properties are, in bad areas, or they are, only slumlords invest in Section 8 because the properties aren't kept up with. But it's actually the opposite. So you have to, without me pulling it up, I know that we have to, in St. Louis, have a property inspection every 2 years. Not only do you have to pass occupancy inspection, so like on a standard multifamily with market rate tenants, all you have to do is pass occupancy inspection, and then now you can rent it out and start getting income. With a Section 8, once you pass occupancy, you also have to pass a Section 8 inspection. They have their own set of guidelines on what they need to have in these properties. Which, when you do that and you add inspections, you also have longer lease up periods. So in a hot market where rental supply is low and tenant demand is high, in a standard market rate tenant, typically when we're done with construction, we will market it and have a tenant found in 30 days or less. With Section 8, we typically underwrite for 60 days. Because if you don't pass the Section 8 inspection, you got to fix that stuff, re-inspect, and then you also have some paperwork that you have to submit. Section 8, which is a government, government entity, they move a little slower, and so you have paperwork you fill out, and then you have to wait to hear back before you actually get a move-in slip, is what they call it.
Love it. So yeah, I like that, man. So you got to pass the property inspection. So it's not like, and that's pretty cool that you bring that up, right? Because I think that's definitely the perception people have out there, that it's going to be like a not good looking place, and things are going to be falling apart. That's why it goes into Section 8. But
Right.
I'm glad that you clear the air on that. It's like a normal rental. If anything, you're even held to a higher standard because the government obviously has their own inspection that you need to pass. And it seems like you guys do some conservative underwriting by obviously estimating a little longer wait time before you can start getting some cash flow on that property, right?
Yeah, and I'd say the other downside is there is a longer eviction process. Just like they have added layers to get a property, to pass occupancy and also to get rented out. They also, have added hoops to jump through in order to evict a tenant. So if you do get a tenant, which, if you think about it, if the waiting list is 2 to 3 years and it's a single mom with 4 kids, it's just a hypothetical there, and they cannot afford to lose their voucher because it's a federal program. And with it being a federal program, they can't just mess up in St. Louis and say, okay, I'm going to, cross the border over into, Chicago, Illinois, and go do Section 8 there. It's a federal program. So if you lose your voucher, you lose your rental assistance. And with that being said, they're highly incentivized to be good tenants. And so a lot of people think that you have, bad tenants, which you do, have a bad tenant every now and then, but that's just like market rate tenants. You'll have a bad tenant with that group as well every now and then. And so that eviction process is longer. But what's great about Section 8 is they will pay rent until the day the sheriff moves them out. So if you have a tenant who's, let's say, is responsible for 30% of the rent each month, then if they don't pay their amount, well, you're still getting 70% from the government. So you have to wait, 3 months before you're really a full month behind on rent. And then when you do start, so you have more time to start that process and go through it before you really start to feel that effect of loss of rent. And then what's great is the program pays until the day. So we just evicted a tenant about 2 weeks ago. She stopped paying it took us a month before we decided to file on her because she was really good at, saying, I'm going to pay, right? And she'd give us like $200. And then we'd think, okay, that's a sign of good faith. She's going to pay. And then we wouldn't hear from her. And so after doing that for 3-4 months, we just decided we're going to go ahead and evict her. So at that point, she stopped paying rent. Then we went to court. The judge was, more lenient. So he, was setting longer court dates to give the tenant time to catch up because she kept saying she was going to. And then our attorney dropped the ball, which delayed us 30 days. So we went, 3 months or so without getting any rent. And that hurts, and it really makes the returns, take a sharp dive and towards the bottom right of the chart whenever that's happening. And with Section 8, they pay up until the day the sheriff shows up and actually moves the tenant out, which is great.
Yeah, absolutely. That's one of the fears that I probably hear and see the most with traditional long-term tenants, which is the landlord may be wanting to sell their property, but they're scared about putting it on the market because they fear that the tenant will stop paying for the last few months that the current owner has the property. There's all kinds of stories, right? So like having that assurance that no matter what happens, you're going to be getting that paycheck from the government is definitely a beautiful thing. Um, Joe, what should what should an investor that is looking to invest look for in an operator?
Yeah, I always say this. I mean, if you can't get on a call with somebody and, meet them, if not face to face, virtually face to face, like we are here on this call, then, and I'm a little biased when I say that, right? Because I do that for all my investors, but I try to tell people that if you need to be able to actually meet the person because you're investing in the person just as much as you are in that investment opportunity and that property, and just as much as you are, in the execution of it. And so you want to invest, you want to get to know them, and you want to, really understand, who they are, because there's a lot of investors who, with the education being more and more plentiful of like how to get into real estate investing, it feels like every time I get on YouTube, there's a new guy that I've never seen before telling people how to, get into real estate. And there's just a lot of people out there who haven't gone through it yet, right? Who haven't, been hit with a sack of bricks or had something go wrong or had something not go to pro forma for, sometimes things that are in their control and sometimes things that are outside their control, like COVID. And, when times get tough, you need someone to, really be able to take the bull by the horns and dig in and make sure that they do whatever's necessary to make the investment still perform. So my partner and I, we've been through it. We haven't seen it all, but we've seen a lot. And, we've been able to make sure that everything is still profitable and there's still great returns for our investors. And, that's the kind of investor you want to invest in. Also, you should know how to maybe not underwrite a property at the same level an active operator would, because there's a lot that goes into it. I mean, we'll look at a deal 20, 30 different ways and stress test it, with a whole bunch of different stress testers. And you might not be able to go that in depth, but you should understand the basics of underwriting a property, or at least know what to look for when someone sends you a pro forma, right? You don't want to just look, get a pro forma in an email, scroll to the bottom, see the IRR is 25%, average annual returns 30%, cash on cash is 15%, and think, oh, that looks good, I'm going to go ahead and invest in that. You wanted to be able to look for things that might be red flags or something that just doesn't make sense, or maybe something that is well above what the rest of the market's offering right now. And so we actually have created a free ebook in regards to that. It's called 67 Questions Passive Investors Should Be Asking. And it's something that it's able to take them through what questions they should be asking. Now, do we want investors to call us and ask all 67 questions? No, but these are also questions they should be asking themselves, right? And they can go through that, and it's kind of like a due diligence checklist. They can look at a pro forma, ask themselves that question and see if it checks out. And if it doesn't, then, we're an open book. We have a Calendly link where investors can hop on and ask us questions about that property, and we'll answer it right then and there live. And so if I were to passively invest in another operator, I would want to be able to, do that with them in order to feel comfortable. So we try to provide that same level of service and transparency to our investors.
I love that. So the 67 questions ebook, where can investors go and find this?
So we need to create a landing page, to be honest. But right now, in the meantime, we just put it right there on our homepage. So our podcast is called Real Estate Cash Flow Channel. And so if you go to www.realestatecashflowchannel.com, then right when you get to the homepage, it's right there at the very top. You see a picture of the book. All you got to do is put your name and email in there, and we email you a PDF copy instantaneously. So it's something that whether people invest with us or not, they should definitely be looking at that, because it's something that could save you or prevent you from investing your hard-earned money in an opportunity that you shouldn't be investing in.
I love it, man. You hear it, guys. 67 questions to ask yourself. Free ebook. You can download it. Go to the website. It's right there below. And I love that, man. Providing value for investors. And obviously, our main goal is for everybody to be as safe as possible with their money that they already earned, right? I like to think myself, I don't gamble, but I'm a little bit aggressive on the money that I use in my personal business. It's my money, and I'm a little bit aggressive with it, trying different things. But when it comes to investing, to me, it's like I already did the hard work to get that money, right? I don't want to lose that money. I don't want to go and put it in something that will give me some crazy return. I'm not looking for that, right? I'm looking for the safe way to put that money somewhere that will give me a consistent return. And so I love that. Go through those questions, and it's kind of like a stress test in itself, right, for investors when they want to pursue the potential of investing in a deal.
Yeah.
Dude, we're reaching the end of our podcast session. We love having you on here today. A lot of stuff to dissect. I'm sure a lot of people will be going back and forth, uh, doing a little bit of research on the stuff that you brought up, because I love a lot of these things. I'm personally not very familiar with the Section 8, so I learned a lot of stuff. What would you say to someone that is brand new and is looking to get started in investing in real estate?
Yeah, well, the easy answer is reach out to a good operator like yourself or myself and, pick their brain. We love talking to investors. I mean, that's besides finding deals, raising capital is the main two components of the business. So if an investor wants to hop on a Zoom call or they want to hop on a phone call and they're serious about investing, they just need to, feel comfortable with it. We enjoy having those conversations, and we have those quite often. And so if, also understand the asset class you're investing in, and also get to know, the group that you're investing with, not just the deal, or maybe not just that 30-minute Zoom call that you have with them, but get to know how they've done in the past, and maybe even reach out and ask to talk to one of the investors who've invested with them in the past. And not an investor who's currently investing and hasn't gone full cycle with them, but somebody who's invested in a deal that's gone full cycle, and they can get the full story out of that person. Because investors talk, we don't do LPs and GPs. We structure ours a little bit differently. But when you're part of a small, tight group of investors in an LP, or those guys talk. So if one guy's not happy, he's definitely letting you know, and he's also letting the other investors know, and you'll be able to get a true sense of what the experience would be like for yourself by talking to them. And one other thing I would add is, if you are interested in a certain value add strategy that someone's implementing, get to know about that. So right now we don't have an ebook or anything right now in regards to Section 8. We've been doing nonstop research since we started doing that investment strategy, and we have a ton of good documents that really break it down in tables and charts that make it really easy to digest the information. And so when investors reach out asking about that because they want to hear more about the recession-proof portion of our portfolio, then we readily just are able to send that to them. We're planning on putting all that together and putting it on the website once we feel like it's pretty conclusive. And it's just right now we're about 80% there. So if they want to get more information about that, they could also feel free to reach out. We have on our website an invest tab, and they can pick a time on our calendar to hop on a quick call and ask for whatever information they want, and we readily send that over.
I love that, man. I love that. I love that access to people. I love that the people can access you, and so that's pretty cool. Joe, appreciate you having you today. This was awesome, and look forward to having you in the future as a guest again.
Yeah, it's a great time. Let's do it again.